tax becomes an afterthought. The problem with that is SARS does not stop considering you as a tax resident until you've ceased tax residency, as I mentioned. For as long as an expat is a tax resident of South Africa, they will continue to be liable on worldwide income and disposal of assets worldwide. Why that's important is individuals are under a very big misconception that once they've left the borders physically of South Africa, that SARS will automatically assume there's no tax paid.
I was hoping we could discuss the double taxation agreement today as a saving grace for rotational workers.
Yeah, I think it's a very interesting topic. Looking forward to the questions you have for me on the topic. I know just in practice, there's a lot of uncertainty specifically for rotational workers as to how they can benefit from some expat tax relief, So hopefully every question you have an answer I give offers some critical insight to those who need it most,
Absolutely. I think let's dive right into it.
Happy to.
So, John Paul, I think the first question I have is, what is the double taxation agreement?
Good starting point. So double taxation agreement is, everyone knows about financial immigration, which is a method of ceasing your tax residency. The double taxation agreement, maybe people not so well aware of, it is essentially an international tax treaty between two countries. So I'll make use of the UK or the Middle East, so the UAE and Saudi Arabia, for example, as well as with the government of South Africa. This agreement or treaty, I'll call it the DTA just for ease of reference, is really tailored to avoid issues of double taxation. They go about this in various ways. The primary, it covers transactions such as dividends, interest in different countries, royalties. A lot of interesting transactions are covered by the double tax agreement. But I think for the purpose of today's discussion, specifically how it can assist rotational workers who are working abroad, is Article 4 generally in the double tax agreement, which actually deals with the ceasing of tax residency. And I won't delve too much into it at the beginning, but it essentially will dictate which country, so rotational worker will either be working in the Middle East, but is a tax resident of South Africa, and possibly a tax resident of the UAE. It dictates which country would have the exclusive taxing right, so that it avoids the individual who is a rotational worker from implicating themselves in double tax or double tax liability between two tax authorities.
Okay, very interesting. So for South African expats, for example, if they go overseas, let's say to the Middle East, how would this apply to them ceasing their tax residency back in South Africa? How can they avoid, liability with SARS?
So look, firstly, it's a layered approach. It is a formal process that we have to follow with SARS. But the starting point is to determine whether you are a dual tax resident. So generally someone who is leaving South Africa to go and work in the Middle East, if we're going to stick with that example, is a tax resident of South Africa. Until they've formally ceased their tax residency in South Africa with SARS, they will continue to be one. The problem with that is obviously SARS levies worldwide tax on income and assets irrespective of where you are earning it or where it is paid. Middle East may be not the best example for us to use, but we can stick with it because there is no direct tax in the Middle East. But however, when you are working in the Middle East, you will trigger tax residency on that side as well. So what the double tax agreement will then do, in short, is apply what we call the tiebreaker test. And we'll go through the tiebreaker test to dictate which country has the exclusive right to tax them as a tax resident. If we then find that at the end of the application of this tiebreaker test in Article 4 of the DTA, that they are deemed exclusively tax resident of, let's say, the UAE, we then approach SARS with a formal application to confirm that SARS, under this double tax agreement, they are deemed exclusively tax resident of the United Arab Emirates. And on that premise, we are then going to be applying to cease their tax residency in South Africa.
Okay, very interesting. So you mentioned that the double taxation agreement is an international instrument. Does that mean that it applies automatically to any South African expats?
Definitely not. As I said, I think the starting point is you need to be at least a dual tax resident. So where you are working abroad and you hopping from country to country, DTA definitely is not the kind of relief you're looking for. If you are spending, let's say, a year, 2 years, 3 years, all the way up to maybe 5, 10 years in a country, you'll obviously have triggered tax residency at some point. And then, like I mentioned, we'd apply the tiebreaker test in Article 4 of a double tax agreement. And then on that outcome, submit the formal documents required by SARS on the respective e-filing profile of the taxpayer and apply for non-tax residency on that basis. So it is definitely not automatic. That is a big misconception that we are seeing with expats. They feel that because there is a double tax agreement in place between the two countries, that it automatically applies. Just on that, that's an incredibly big misconception, because I will often refer to this section as one of the most important ones, I feel, of our Tax Administration Act, which says, Section 102, the taxpayer bears the onus to show SARS what shouldn't be taxed or what does not need to be declared as taxable. So, barring an expat actually formally approaching SARS to confirm the application of the DTA to this scenario, they will still bear the onus to prove it. And how do you prove it? You prove it by applying to SARS. So, definitely not an automatic application.
Okay, very interesting. Glad we could clear up that misconception. You mentioned the tiebreaker test. Can we maybe delve into each part of the tiebreaker test?
Yeah, in short, I mean, a tiebreaker test really is to determine where someone's other permanent home, and it's a layered test, as I mentioned. We first look at where someone's permanent home would be situated. If they have a rental property in South Africa available to them, or a permanent home, such as they own an immovable property that's vacant, that would be considered a permanent home in South Africa. In the country they're currently working in, places such as rental accommodation, company-provided accommodation, or if they at least own a property in the country they're living in that's vacant, that would be considered a permanent home in that relevant country. Where we cannot break the tie there, because possibly they have a permanent home in both jurisdictions, we then move on to the next step, which is centre of vital interests. This really looks into where your economic interests are, as well as your personal relations. Based on the location of those two critical factors, it would then be either deemed it's still located in South Africa, alternatively in the UAE, if we're using that to continue the example. If we cannot break it there, we'll have to go to something which is called habitual abode. And that really looks at where, to sum it up, in layman's terms, where would you usually be found during a year? And based on those three kind of criteria, we would determine which country would have the exclusive taxing right. It is a whole inquiry. I can't elaborate too much on it, obviously, but that's essentially an overview of what we would look at in terms of determining tax residency.
So, John Paul, now that we've covered the basics surrounding the DTA, why should South African expats worry about their tax status back in South Africa?
Well, firstly, I think everyone has seen from news articles, from some of the publications even we've put out, SARS needs to collect revenue. That's their primary focus. It's not news that there's a lot of expats that are leaving South Africa to go and work abroad. The money's nice, and it offers a brighter future for anyone who's looking to save for retirement. It's one of the biggest reasons I see in consulting with individuals. It's they're looking to set themselves up for retirement. That can be incredibly detrimental when everyone plans their immigration, their visas, etc., where tax becomes an afterthought. The problem with that is SARS does not stop considering you as a tax resident until you've ceased tax residency, as I mentioned. For as long as an expat is a tax resident of South Africa, they will continue to be liable on worldwide income and disposal of assets worldwide. Why that's important is individuals are under a very big misconception that once they've left the borders physically of South Africa, that SARS will automatically assume there's no tax payable. Alternatively, in the expat's mind, that there's no tax payable because they're earning it from outside of South Africa. This is the stark contrast, actually. SARS will place on the taxpayer an obligation to declare all worldwide income and assets. So if it's not being declared, it could also be considered a criminal offense. That's obviously on the radical scale, but the reality of the fact is that income needs to be declared and taxed in South Africa unless there is an exemption or a non-tax residency application that's been approved. So if you are looking to work abroad or are working abroad for the purpose of financial benefit and don't exclude the tax that you're going to be paying in South Africa, which obviously we are aware of, can be incredibly high up to your 45%, it would defeat the purpose of going abroad, because that tax, as you're aware, in some of the consults we've had together, individuals are having to pay a lot of tax on their foreign earned income after the fact they found out that they're now liable to SARS. So it should always be a thought at the front of your minds of dealing with your tax residency. Where you can cease your tax residency, we urge all expats to do so as soon as they are eligible to do so, to avoid any implication of tax liability in South Africa. Aside from that, going abroad does not put the end of your tax compliance in South Africa. So that has to be a priority.
Very eye-opening indeed. Would you say it's fair to assume or to say that the double taxation agreement is a saving grace then for rotational workers?
Definitely. And I know that's the purpose of this podcast. So I think just to pause there and really reflect, everyone is very well aware of the financial immigration process in South Africa. That is an indication to SARS that you are ceasing your tax residency on the basis of what's called being ordinarily resident. What that means for our listeners, that essentially means that you consider South Africa your home. So to cease tax residency under financial or tax immigration, as they call it, you have to indicate to SARS that you don't consider South Africa your home and you don't plan to come back to South Africa. So it's an incredibly onerous declaration to make to SARS because we don't know what the future holds, firstly. And especially those who are working in the Middle East. I mean, one of our biggest expat countries is the UAE, where in the UAE, your residence is linked to your employment. Often how your employment is set up in those types of countries is it's a 2-year contract renewable on a biannual basis, for example. So there's a lot of uncertainty as to, firstly, whether you're going to have to come back to South Africa or not. And secondly, more so for those rotational workers. Rotational workers are firstly working, let's say, a rotation of a 6-week on, 2-week off. So they'll work 6 weeks in the UAE, 2 weeks in South Africa, and that would be their rotational split. So under financial immigration, you can't declare to SARS that South Africa is not your home because you're spending copious amounts of time physically present in South Africa. So while it would be a saving grace to those individuals is, firstly, the double tax agreement does not require that you indicate to SARS that you are not coming back. South Africa is still your home, and if you want to cease tax residency on that basis, the double tax agreement, as I mentioned, looks at the tiebreaker test to determine who has the sole right to tax your income as a tax resident. It secondly is a saving grace for rotational workers because it gives you a lot more leniency in terms of physical presence in South Africa. So if you are looking to come back every 6 weeks on a 2-week, 6-week rotation, it doesn't require that you have to limit yourself to the 91 days physically present in South Africa. Under financial immigration, if we have ceased your tax residency on that basis, and the following year you spend 91 days physically present in South Africa, you'll find yourself having re-triggered that tax residency. In terms of the double tax agreement, you have, well, let me put it this way. With it being an international treaty, our local South African Income Tax Act recognizes that it overrides our local South African tax residency tests. So by implication of that, where DTA is successfully approved and in place, you cannot trigger tax residency again if you are basing it on physical presence like you can with financial immigration. So to summarize those 2 points, it's essentially the double tax agreement is tailored for someone who does not want to say South Africa is no longer their home and actually plans to come back to South Africa frequently or alternatively for retirement. Secondly, it offers the leniency of the physical presence in South Africa. Often we find rotational workers' families stay in South Africa, their friends are in South Africa, they still have a home in South Africa that they come back to. So barring an outright indication that to SARS that you are financially immigrating, the double tax agreement offers a nice middle ground, I call it, in terms of offering non-tax residency for those who still plan to come back to South Africa.
Yeah, very interesting. So I know there are different ways to cease your tax residency. So how does the double taxation agreement differ from, let's say, financial immigration as well as the Section 10(102) exemption?
So I think I'll start with the Section 10(102) exemption. This is very well known as, well, some people actually get it confused, the Section 10 exemption and the double tax agreement. The most important thing to understand is that those are 2 completely separate mechanisms. The exemption on foreign employment income is capped at 1.25 million rand and is under local South African tax law. That relief is the one that you'll hear everyone talk about. I've spent more than 183 days out the country, 60 days continuous. That's your Section 10(102) foreign employment income exemption. Under a double tax agreement, those days requirements fall away. There's no set days requirements in terms of spending 183 days out the country, 60 days continuous. So that's the first thing. The DTA relief is also unlimited. It's not capped at 1.25 million rand like the Section 10 exemption. And thirdly, the Section 10 exemption only relates to employment income. While that's important is independent contractors, freelancers, and self-employed persons cannot rely on that relief. I have seen in practice a lot of individuals that do approach me. are under the false impression that they can rely on that exemption, only to find out that it's only related to employment income. So where there's an employer and employee relationship. So those individuals that it doesn't apply to, the double tax agreement is perfect for them. Secondly, the Section 10102 is still not automatic, but it doesn't cease your tax residency. The double tax agreement process does. In terms of your financial immigration process versus the double tax agreement process, as I mentioned, financial immigration is an outright declaration to SARS that you no longer plan to come back. So in other words, it's not your home. You're not coming back for retirement. You are leaving the shores of South Africa for good, and you're setting up a home elsewhere. So the double tax agreement obviously offers the flexibility of not having to close that door to South Africa. Some other differences, I mean, they're both financial immigration and the double tax agreement both cease your tax residency. You, interestingly enough, get the same outcome document, we call it, which is your notice of confirmation of non-tax status letter. They both have no expiry date, but bearing in mind that if you want to rely on the DTA relief year on year, you need to continue to be a tax resident in the country that you've applied for. Financial immigration is that also a once-off application, but it doesn't rely on dual tax residency. So for someone who is leaving permanently and going to various countries, that is better tailored for them, if that makes sense.
Is the double tax agreement a once-off application?
It is. It's a once-off application that remains in effect for as long as you establish that you are still a tax resident of the UAE next year, for example. So under both processes, you still file your tax returns. When you file your tax return for the DTA process, you'll just confirm you're still a tax resident in the UAE going on. And then that will offer relief in perpetuity for as long as you continue to work and live in the UAE and are a tax resident there.
Very informative. So ultimately, why tax consulting South Africa?
Well, I think it's firstly, it's something that everyone needs to make up their mind about in terms of what kind of service they're looking for. Obviously, we do pride ourselves on offering a premium service. So we are the ones who have written the legal textbook on expatriate tax. So if I may say, tongue-in-cheek, we are at the forefront of the law of this area of tax. We also have been in existence for over 20 years, offering excellent service that's been tailored and also focused on international and expatriates tax, So it's what we live and breathe. Every department within our company is specialized to the section of work that they do. So, for example, with me, in our cross-border tax department, we live and breathe everything cross-border tax, whether it be from individuals to other forms of relief under the double tax agreement. So you really want to be dealing with someone where it is such a niche area of tax law, someone who specializes in it and actually focuses their core function on offering guidance in this area. So I could keep going, but really it's a team that is well versed in this area of tax law and supported by a full turnkey solution. From a disputes team, from a employment tax team, cross-border tax team, tax technical team. We've got a treasury department for those expats looking for cross-border fund transfers. So we've really tried to develop a kind of service that is a one-stop shop for every expat, whether you are an income earner, a middle income earner, all the way to your high net worth individuals. And that's something we pride ourselves on.
Thank you so much, JP. I've thoroughly enjoyed our conversation. Learned a lot about expat tax, especially the double taxation agreement as a saving grace for rotational workers.
Been an absolute pleasure sitting here to speak to you, and I hope it offered some guidance and assistance to those listeners. And I do hope that maybe after listening to this, they reach out and we can actually just get a bit more down into the detail of their personal scenario to see how we can help.
Absolutely.
Thank you, Mornay.
Thank you, JP.